And welcome to the show, everybody. Grow My TSP weekly podcast every week. Two old guys talking about the thrift savings plan. Maybe someday there'll be younger guys, but it won't be us. But
it would be good to get some younger guys into the group.
Yeah.
You know?
I've been kind of giving some thoughts here during the last couple of weeks of the year of how we might, wrangle somebody from either our membership group, or from our website, our subscribers, or, it would probably be best, or potentially somebody that watches this on YouTube. I don't know why they'd watch it and wouldn't be a subscriber, but maybe there is somebody out there that doesn't eventually become a subscriber. But it would be kind of cool to have some some outside viewpoints, just some fresh ideas. So I'm bringing that up on purpose. I just thought that as we kick this off, new year, if you're listening to this, watching this, hit us up. You can send support at growmytsp.com. If you have any interest in that, obviously it would be a volunteer position. So we're not looking for anybody that's looking for a job. But yeah, if you have any interest, I don't know, it might even just be like a one-time thing, or, an interview. I don't know.
Yeah. Guest host could be all kinds of
something
things.
Just to kind of, give a little bit of fresh viewpoint. I think it would be cool. We're thinking about doing these live for the subscribers. It's very difficult because sometimes we don't always do it at the same time. We're different locations and traveling around and stuff. So, but give us some thoughts as we come into the new year. Anybody else have any thoughts? Like I said, hit us up. Give us your thoughts. What do you got for us, Jerry?
Well, we're starting off the year kind of a bit of a whimper, actually. We'll talk about where we're at in the Santa Claus rally phase. So let's just kind of get into it. TSP Weekly Podcast, January 4th, 2026. So take a look at some economic highlights. It was kind of a slow week because January 1st was a holiday and the market was closed. But all the analyst targets came out for 2026 within the last couple of weeks. So we got them all kind of correlated into one place, and we'll see what, generally speaking, the big analysts on Wall Street think is going to happen in 2026. And then failed Santa Claus rally, ? Basically because we're a little bit below where we ordinarily would be historically at this point in the Santa Claus rally, which is the last 5 trading days of the year and the first 2 trading days of the following year. So tomorrow will be the end of the Santa Claus rally. And then we'll take a look at some basic charting analysis of the S&P 500 as we launch in here to 2026, and then the TSP fund direction. So both the 3-month and 6-month bond auctions this week required slightly higher rates than the last auction. So the higher interest rates the government has to pay to get investors to buy bonds, the more we're adding to the deficit. So we want that's one of the biggest reasons why the administration wants rates to come down, preferably the longer end of the yield curve, meaning the 3-month and 6-month bonds are the short end. And the 10-year, 20-year are the long end. If we sell 20-year bonds at a low interest rate, then we have that, that's locked in for 20 years. If you're selling 3-month bonds at a low rate, you have to roll those bonds over at the new rate 3 months later. So it's much less stable when the government's selling short-term bonds, much more stable if they can sell long bonds at a low rate. So ultimately, that's what we're trying to do. This is a chart of the 6-month bond yield. So the 6-month correlates pretty closely to what the Fed does. So when the Fed lowers rates, it really affects the short-term rates, which is why we're seeing, the short-term rates coming down quite a bit over the past year, while the long-term rates have not come down. But it's stabilizing here. It's ticked up a little bit, which is why we had to pay a little bit higher rates at the bond auction this week than last week. But hopefully this interest rate continues heading down, because that would be good for the deficit. Initial jobless claims came in 199,000 versus an expected 220,000. So quite a bit better than what analysts expected for initial jobless claims, which is good because the unemployment rate ticked up to 4.6% last month. And it triggered the SOM rule, and a lot of people now are looking at unemployment as one of the big issues in 2026. But continuing but this is a good number for this week anyway. 199,000 versus 220,000, and continuing claims also declined. So this is what the initial claims looked at for a 1 year period. I mean, this was the second lowest initial jobless claims of the year. So that's pretty good, right? There are fewer people claiming unemployment benefits, because that's basically what that is. It's how many people came in and said they were, initially lost their job. They're claiming unemployment benefits. So the lower that number, the better off. Certainly, the better off we are. And a couple on housing. This is a pretty interesting one that came out. HPI is a housing index. It's a broad measure of the movement of single family house prices. So it's a weighted repeat sales index, meaning that it measures the average price change in repeat sales or refinancing of the same property. So it's kind of apples to apples, like you're looking at one house over time and seeing how much that house goes up every time the person either sells it or refis it, which is pretty interesting information to have. And it's all, it's basically only the things that are available, the loans that are managed by Fannie Mae and Freddie Mac. But it's going back to 1975. So it's a lot of pretty good data there. And this chart is cumulative, right? So housing was pretty cheap back here in 2016, right? So ideally, the way you're looking at this is, a house back here at somewhere below 240,000 in 2016 is now over 420,000 in beginning of 2026. So, housing generally goes up. This is probably the average slope, right? We had this boom after COVID, stabilized prices in 2022 as we had that bear market in stocks. Then we had another big rally in housing in 2023 into 2025, and stabilized a little bit, the beginning of 2025, but then has been reaccelerating to the upside. So good for homeowners because it gives you more equity in your house. Bad for affordability for people that are trying to buy houses. And so again, interest rates are going to be really interesting to see what happens. If rates do come down, it'll lower. If prices stay the same and rates come down, then it lowers the monthly payment that you have to make for mortgage payments. But what usually happens is when rates come down, the price of housing goes up. So it's going to be interesting to see again this year what happens with that. And you guys remember back in 2020, somewhere in here, interest rates were, or mortgage rates were like 3%. A lot of housing growth when we had really low rates. Then rates started going up, and it kind of stalled housing prices going up for a little bit. So what happened was rates went up and housing price also went up, which is very unusual. So the question now is, do rates come down and prices also go up, right? Which is, again, great if you own a house, really bad for affordability if you're trying to buy one. Okay, and then this is a kind of a retake of the same kind of stat. U.S. single-family home prices, backed by Fannie Mae and Freddie Mac, rose 0.4 in October 2025. So the expectation was that we're only going to go up 0.1%, but we went up 0.4% in 2025. So the value of your house went up 0.4 versus 0.1. Year over year, home prices were up 1.7%. So what does that mean? Because this is usually how they show the charts. They don't usually show it cumulative like the last one. They show it this way. So this is a 10-year chart of kind of the same data, but the point is we had a big move up in housing, right? And after COVID, this is kind of the normal range. So you can expect, right, month over month, housing prices goes up 0.5%. So this is the 0.5% line. So that's kind of, more or less the average that you would expect housing prices to go up. And sometimes they go up more, sometimes they go up less, but more or less 0.5%. But when they're going up 1.5% or more every month, that's a boom in real estate. And they're still going up. I mean, this is pretty much average, right? We're still definitely, housing prices are still going up. And if rates come down, there's every reason to believe that prices continue to go up, which again is great if you own a house. It's just really tough if you don't. Okay, so what are the analysts saying for 2026? So I got this off of Twitter. This is the handle there. There's obviously a whole bunch of analyst expectation for 2026. So Oppenheimer was the highest. They're expecting the S&P 500 at 8,100 by the end of 2026. And Stifel Nicholas was the lowest at 7,000. So the average of all of these was 11.5% increase in the S&P 500 for 2026. Okay. The median was a little bit higher at 12.5%, and the lowest was 2.3%. What I thought was really interesting out of this is these two right here. So Yardeni Research and Fundstrat. Ed Yardeni is very bullish, almost always. He does great analysis, and he's generally very bullish. And for him to come in quite a bit, he was the median. So for him to come in as the median, I thought was pretty interesting. And then Tom Lee is the director of Fundstrat. He also came in at the median. And if you follow him at all, he's all over YouTube, CNBC. He's bullish for the year, obviously, because he's at the median, at a 12% increase for the S&P for 2026. But he's talking about a pretty rough first half of the year. And pretty much all of these, if you go back and look at their reports, they're all talking about a pretty rough first half of the year, and then a big rally into like fourth quarter and into the beginning of next year.
Yeah, I think from what I've been seeing, a lot of the folks, and it kind of shows up here in this, is a good kind of graphic for to show everything. I hadn't seen this is good, because what I've kind of got the feeling lately, just listening to the narrative, a lot of people are kind of hedging their bets, right? They're trying to kind of roll back the crystal ball a little bit and not be so decisive about where the market's going to go, because they know the same thing that we do. Nobody knows.
Yeah.
Right. So if you pick the median, if you kind of stay in the middle, you're not going to be that far off, probably. Right. So I've heard a lot of people that kind of like are talking a little slower. They're hesitating before they're kind of jumping in on words, and that tells me that if the smartest people in the room are doing that, then that doesn't give a lot of strength to it doesn't give you a lot of hope to say that. Which we used to say this all the time, and I still abide by it. Hope is not a plan. Hope is not a strategy. So if you're hoping that the market is going to come back because of all the crazy things that you hear in the news, that is not a good investment strategy at all. Right now, it's nice to look at numbers like this to kind of see where the smart people are thinking. But my takeaway from that, honestly, is like you pointed out, if you go and you don't even have to like read a bunch, you could just Google a few of these names and it'll tell you, whether they're bearish or bullish, kind of normally, like you said. And if you see a hardcore bull kind of going for the middle ground, that should tell you something. And my takeaway from that is just walk softly. Invest wisely, slowly, and just keep your eye on the ball. Don't go, if you want to go off and put your head in the sand, then you better put your stuff in a G fund or the money market or something and let it stay in cash. Yeah.
The thing about this that I didn't realize until last year that's kind of annoying, when the same groups come out every year and give their projection for the year. And some of them will stick with that projection for the year. They'll give a target, a forecast, and they'll stay with it for the whole year. But most of these guys came back in April 2025 and redid their whole thing. And it was much lower, right? So they respond to what the market does, and
I don't blame them though, right? Like,
no, I don't blame them.
I don't think it's fair to like, hold them to what they said in December, once you get to like August, unless you just want a soundbite, right? But if you really care what these folks think and this is their day job, then yeah, I mean, there's nothing wrong with, now if they did it every month, that wouldn't be useful, right? But it's nothing wrong with coming back a quarter or two later and saying, yeah, things aren't quite going how we thought they were, right?
Yeah. Well, we did a chart last week. We're going to show the same one this week, and we'll see what they also expect. Well, not they, but what the cycles are telling us that we should expect for the year. So this is just kind of a graphic of what it would look like, right? This isn't all those, but it's the majority of them, and that's kind of what the S&P would look like if we got up here to say Deutsche Bank's target of 8,000. But it's very likely, or the cycles would indicate that it does something like this. And this will be really spooky for people, that part. All right. So Santa Claus rally, like I said, we got 1 day left in the Santa Claus rally. It happens 80% of the time. So the odds are that we do get a Santa Claus rally. The average rally is 1.3%. The last 5 trading days of the year, the first 2 trading days of the following year. That's kind of the first part of like the triumvirate, they call it, the Santa Claus rally, then the first week of January, and then the month of January. So the idea is Santa Claus rally kind of is the foundation. The first week of January is positive 63% of the time. And the last part of it is as goes the month of January, so goes the year, is the idea. And that happens about 50-50. So does it really matter? This is where we were going into 2025. And the Santa Claus rally failed, right? This is December going into January. So the Santa Claus rally failed in 2025. January was, a little bit positive, basically flat. And then we had, a little bit of rally into February and then rolled over. And we can say, yeah, but that was just because of the tariff scare and everything else that ultimately bottomed in April. And that's true. Certainly the tariffs had a lot to do with it. But the formation of the chart, right? We put in a high at the beginning of December, have this correction, got back to the prior high, couldn't really get above it, churned around for a while, barely got above it here, and then rolled over. And where we are right now, we put in this high in October, we get that correction going into November, we came back up, we've been testing it, right? Had a little pullback in November, came back up again. We're not really, above that prior October high yet. I mean, technically this 1 day got there, right? But we're not decisively above the prior high. Okay. And this pattern looks pretty similar to this pattern. And it doesn't mean we're going to roll over here in the first quarter. I'm just saying the patterns look very similar. So what we want to see is some kind of decisive move above this high. If we got up here above 7,000, we're in good shape, right? The good thing with this is basically flat, but we have higher lows. So as long as we keep putting in higher lows, eventually we're going to break to the upside. It's an ascending triangle. Right. And then, of course, this was a cautionary tale from Yale Hirsch that came up with the Santa Claus rally. If Santa Claus should fail to call, bears may come to Broad and Wall. Right. It's an adage by Yale Hirsch. Means that weak stock market performance during the last few days of December and the first few days of January can signal a coming bear market or economic downturn. And again, does it matter? Like we saw that in 2025, right? It was not great going into the beginning of 2025. And then we had the big pullback. This is a 20% decline. So it was a significant decline into April, but then we, rallied and never looked back. We never had the pullback that everybody was looking for. This is what everybody was looking for to get bullish down here, and we never got it. But the market kept rallying, and we're finished up about 16% for the year. So does it really matter, right? Does the Santa Claus rally really matter at the end of the year? Could we still be up, even though we have a failed Santa Claus rally? Yes, absolutely. All right. So having said all that, what does it look like as we start 2026? So this is the chart I was talking about. What kind of the year might look like. This is Ned Davis research. They combined it's the S&P 500 cycle composite for 2026. So they combine the 1 year historical years ending in 6, the decennial cycle, and the presidential cycle, and they put that all into this chart. And the important thing here is trend is more important than level. So, we're not looking at this saying, okay, we're going to have a huge move down. What it's saying is this is what the price pattern should look like over the course of the year. So this could be a 5% decline, could be a 20% decline, right? It's just that that's what the pattern should look like. And the idea is a strong start to the year, 2 pretty good corrections, and the last one going into October, basically the midterm election cycle. And then after the midterm election cycle, we get a lot of the unknowns will happen after this midterm election. This is going to be a big midterm election cycle. A lot of the unknowns are going to become known. What's going to happen going forward, and the market doesn't really care, if the House stays Republican, if all the different possibilities. They just want the ambiguity to be gone. So that's why we tend to get a strong finish out of midterm election years. And this is also where where a lot of people are talking about, we get a strong first quarter, and then a rough second and third quarter, and then a really strong fourth quarter, and that's how you get. If you Google most of those forecasts, they're all saying that they're expecting the majority of gains to happen in the fourth quarter. So this is where we are right now in the S&P. What I did here was I connected. This is a weekly chart of the S&P. This is the bottom from COVID. And all I did was connect the bottoms, all the major bottoms that we've had since then. And I made a parallel line going up, and I brought it to this high right here. So right now we are trying to we've been hitting resistance, right, since the summer, really. We can't seem to get above that line. It's acting as resistance. It's been acting as resistance for months. So the history of this line would suggest that we hit resistance here, come back down, and as this line continues higher, we get support down here and keep going, right? That's kind of the bearish case. The bullish case is we get above this line. Again, 7,000 is a pretty important one. We get above 7,000, and then any pullback, this line should be support, and we keep going higher. So if we can get above this resistance level, we should be in pretty good shape. But this is definitely a concern, right? Because right now, the expectation looking at this chart is that price rolls over. But again, there's no point in guessing.
Yeah, let me pose another option, because I was kind of looking at something similar. I didn't do it quite the same way you did, but it could still go up and travel right on that line.
Absolutely.
Now, it wouldn't necessarily be a sideways movement, but it would kind of fit into that scenario. It'd still be kind of slowly going up. And if you were zoomed in, you probably would barely see it. Or maybe the other way around. You'd have to zoom out to make sure you do see it. It's still traveling up that line. So it would be kind of support, but in a sort of like really, does that make sense what I'm saying? Just kind of following that line up. It still goes up, right?
Yeah. Oh yeah.
It's still going higher. It wouldn't be as kind of as hard as those other ups and downs. Now that wouldn't fit the pattern though, right? So that's where I don't put a whole lot of weight into that option. I would call that option C or whatever. But I kind of thought about it, and I was like, well, because when you kind of zoom in there a little bit, it is traveling side to side a little. We're still kind of in that. It's not found its direction yet, right? It hasn't found its real trend. I feel like when you go from right there where you're drawing, right, it's still kind of sideways.
Yeah.
It's not tight enough that you can make any decisions based off of it. But anyway, I just thought that was a different way to look at it, where it didn't necessarily have to kind of go way up past that line. It could just travel up that line like it's kind of doing right now. And we could see, how long that lasts. But this is a monthly or a weekly chart?
Weekly.
Yeah. I think it's possible. I don't know. We're going to keep an eye on it.
The hard part about this, when we get churn like that, right? This is where you get whipsaws on a daily basis. These areas are very difficult. If you're trying to manage TSP on a day-to-day basis, it's very tough.
Yeah. I'm more of a weekly than a daily person anyway. And we've been preaching that really since the beginning. If you once a week sit down and take a look at your positions, where your TSP is, your percentages, your allocations, and kind of make an idea for what, if something, if X, Y, and Z happens the next week, you're going to make these choices, right? And it's really a weekly game, right? It's too volatile. A, the market's too volatile right now. And B, you can't even do it in the TSP if you wanted to, right? You can't make daily decisions. And so it's very hard to just ignore that. There's nothing wrong with checking in data to see what the market's doing. I'm not saying ignore it, but make decisions on a weekly basis. And you're going to have a lot less stress in your life, and you're also probably going to perform better, honestly, because if you go back and look at the weekly charts, there's not a whole lot to be kind of scared of, right? Yeah, it's just not, because the market is generally going up. The S fund may falter a little bit, or the C fund may go up, or the I, they may kind of kick back and forth. But when you go back and look at it, they're generally going up right now. And we haven't seen anything too crazy yet. Now, that doesn't mean it's going to keep doing that, right? So don't ignore it. But we could very easily have that first scenario, the bearish version that Jerry showed. That would be absolutely within reason, is to have the market come back down, even if it didn't go all the way back down to the bottom line, right?
Yep.
It could, kind of make its way down a little bit and then come back up. That's just normal. So
yeah, on the weekly, this is a pretty good chart to show it to, because you start down here at the bottom of COVID. Of course, there are going to be some pullbacks, right? Nothing goes up in a straight line. We had a run off the bottom from COVID. Then we get this initial 3 weeks of a pullback here, a reversal. We went sideways, right? This ABC correction, and then kept on going. And that kind of gave you your first, consolidation area. So if you got below that, you knew something, it's not, you don't want to get below that. So once we got above it, it kept on going in the channel again. And, it's going higher until this week right here. Obviously, that week was different than this whole move. So this, that was a change, and it gets really obvious on the weekly chart. And then we went into the 2022 bear market. Same kind of thing up here, right? We had this consolidation for a long time, and this week we broke to the downside. So it would be the same thing here. As I'm looking at this on a weekly basis, I want to get above this line, but this is the bottom. If we get a week down here somewhere, it's very likely that we're going down from there.
Yeah, I tend to think that's the most probable version right now, but still trying to be optimistic. But that would fit the pattern way better than the other versions we've talked about, right? And it also fits in with what a lot of the analysts are saying, right? They're saying, hey, that we're looking for a pullback here in the early part of the year. So we'll see.
Yep. So if we did get a pullback, well, no, let me just do this first. So one of the things, so Fibonacci, so you get the parallel trend lines that have us at a resistance level. Then you get, if you do a Fibonacci extension of this top going into 2022 to the bottom of 2022, right? You do a Fibonacci extension. The most common level to expect some kind of resistance or a pullback is the 1.618 extension level. So you start at the top, you pull the tool down to the bottom, and it gives you this 1.618 extension level. And when we hit it, we were basically right at it, and we had this pullback. Then when we got above it, now we've cleared through resistance there, and we're going up to the next one, which was 2.0. We got to 2.0 right at it and had that collapse into April. Then we got back above it again, And we're going up to the next one, which is 2.618. And that's where we are right now. Okay, so that's how you're doing a Fibonacci extension analysis of the 2022 bear market. And if we do the same thing from the high in 2025 down to the April bottom, we are at that 1618 extension of that right now. So these two, the 2.618 of the 2022 bear market and the 1.618 of that bear market, 20% down that we had into that April low, is giving us this channel where we are right now. So we have a lot of resistance there. If we can break through it like we did on that week and like we did on that week, that's why I'm saying the 7,000 level is so important, because it'll tell us that we've broken through that Fibonacci extension resistance level, and we're going to be heading up to the next levels for, the next expected resistance. So that's what we want to see. We want to see us clearing that channel, and then we're moving higher. But this is also a good place where we hit it and we roll over, right? So the parallel lines are telling us to be cautious. The Fibonacci extension levels are telling us to be cautious. If the market was to roll over roughly where it is right now, a lot of times what happens is we hit a top, we come back down, and we get to a prior high, right? We had all this. This was the first big consolidation off the COVID bottom that we looked at earlier. And so 2022, that's where we got back to, the top of that consolidation channel. And then we kept going. And then in April, so we put in a high. Then in April, we came all the way back down to the prior high. So if we did the same thing this time and we came down to the prior high, right, this is roughly the channel that we'd be looking at. And that's about a 10% decline. So as long as we stayed above that, as long as we stay in here somewhere, and then the market keeps on going, that fits that chart. It's great. It's a 10% decline, pretty consistent with what analysts are calling for. Big rally into the end of the year. I mean, that could be how it looks for the year. Okay. But again, this is kind of sort of crystal ball stuff in that what are the possibilities, not in what is going to happen. And this is really the consolidation channel that we talked about. So if we get down here somewhere, it's likely we're coming down to this level. We get above 7,000, we keep on moving. Okay, so fund direction right now. We talked about this monthly hangman pattern, right? We talked about it in the newsletter and on the podcast a couple of weeks ago, because November, we had a big, pullback in November. And then by the end of the month, we opened at the bottom of that little rectangle. We opened at the top of the little rectangle, closed at the bottom of it. So closed a little bit lower for the month than when we started, which is why the rectangle is red. But it opened above the high from October, and it closed basically at the same place, but also above the high from October. So it was kind of hanging. It's a hangman candle, it's called. It's a bearish candle. So if we had seen a red December, if we had a candle like this in December, then the expectation is the market goes down. December actually is kind of inconclusive. It does technically confirm the hangman, because we opened at the bottom of that rectangle, closed at the top of the rectangle, but we didn't get, the close was below November's low. So technically, price should come down. But it would be much better. It would have been much better for the pattern if we had a decisive red candle in December, but we didn't get that. So it's going to be interesting to see. I'm going to call this inconclusive. Okay, from a weekly perspective, again, we put in this high at the end of October. This was a pretty good week, but again, not decisive enough to really break us out of that sideways trend. So anything in here, we could definitely come down to that line, right? This is kind of the channel that we're in right now. And you got relative strength below the moving average of relative strength, which it basically is showing weakness. And you got MACD, which hasn't been positive since the beginning of November. So the rally is weakening. Doesn't mean it can't pick up strength and start moving higher again. It's just that it's weakening. And if you go back and look, the biggest moves that we have are when we have some kind of correction, right? Relative strength gets down below 50 and then starts moving higher, and price is moving higher, and MACD is moving higher. Like, this is when we get big bull rallies, when they're all moving higher together. When price starts to, price can continue higher, but when relative strength starts to fall off and MACD starts to fall off, eventually price starts to fall off also. And that's kind of where we are right now, right? You get price still trickling higher, relative strength not going higher, and MACD is still negative. So it's just weakening. The other one to really look at is the Nasdaq. So the Nasdaq is the tech index. We all know that the big tech companies are what's been driving the rally really since 2023. And the Nasdaq right now is in this very clear triangle pattern. So it put in a top in October. We had that correction into November, and then it couldn't get back up to the prior high. Rolled over, but it put in a higher low. Right? Then rallied again, couldn't get above this high. And in the last couple of days, it's been rolling over. So as of now, we have a higher low. So we have these three higher lows and these three lower highs. So we have a triangle. So rather than trying to kind of guess which way the market's going to go, if we just connect the triangle, it's going to break out one way or the other. And when it does, you're going to know which way the market's going to go. That's the beauty of a triangle pattern. You don't have to guess, and you just respond when it breaks out, whichever direction it goes. So if we get above this high, the Nasdaq is very likely to keep going higher, and the S&P is going to go higher. If we get below this low, it's very likely the Nasdaq, the tech index, is going down, and the S&P goes down with it. So this is kind of a better chart to look at, because a triangle is a much easier pattern to kind of look at than where the S&P is right now. And then the bond market, depending on who you listen to, we've been flat since the summer of 2022, right? And generally, we've been oscillating below that 100 level. You can hear analysts talk about how great the bond market was in 2025, and it was. We went up from 96 to 100 in 2025. So the bond market rallied in 2025. But if you look at it from a bigger perspective, we haven't gone anywhere since the summer of 2022. And so if the new Fed chairman comes in, lowers rates, and the bond market plays along, then you'll get a rally in bonds because yields will go down and the price of bonds will go up. If the bond market does not play along, if investors demand a higher rate of return to buy U.S. debt, the yield will go up and the price of bonds will go down. And that is not good for stocks either. And it's not good for, if interest rates go up, that's not good for housing. Interest rates are going to be one of the biggest things. Unemployment and interest rates are going to be the two of the biggest things that happen in 2026. Okay. Questions?
All right, guys, if you have any questions, you can always put them in the comment section wherever you find this video. And if we don't have a comment section where you find the video, you can shoot us an email, support@growmytsp.com, and the support team will get it over to us. Hope you guys are having a good start of the year. A lot of things going on this year. Make sure you keep tuning in, and if you like what you see, please share it with your friends. If you really like it, share it with your enemies. All right. We will see you guys later. We're out of here.